Hello,
Great.
everyone.
Okay.
Hello, everyone, and welcome to the 90th edition of the Alpha Strategist, which we have titled The Great Divide. I am Nitin Shanbag. I head investment products, and I shall be exploring this edition with Mr. Ashish Shanker, Deputy Managing Director, Head of Investments, who also chairs our investment committee and who really has been the architect of the Alpha Strategist. Welcome, Ashish, to this
Thanks,
discussion.
Nitin. It's great to do this live on YouTube this time.
Right. So first off, in equities, we've seen quite a surprising rally in the equity markets, especially in the US with the Nasdaq touching 10,000. It's off those highs at the time being. Even in the domestic markets, the Nifty has rallied almost 25 to 30% from its lows in March, while it's still about 20% off from the highs that it saw pre-COVID in February. And all of this has really happened at a time when the economy is going through a slowdown phase. How do you interpret this movement, and what would be your advice for equity investors?
Yes, so the entire hypothesis behind the theme, the Great Divide, is exactly this. Because on one hand, you're seeing economies being shut down due to the pandemic, and a lot of small and medium-sized businesses are struggling. And on the other side, you are basically seeing the markets hitting all-time highs, at least in the US. In India, they're still down about 17, 18% from their peaks. Now, this is an experiment that we've never seen before. And why do I say that? Is because in 2008, what really happened was the Fed opened their purse strings and there was a lot of monetary action, right? And that was probably enough to bring the economy back from the brink of recession, and gradually we recovered. However, remember one thing: when the Fed loosened their purse strings in 2009, the velocity of money still didn't move. I mean, in the sense that typically what happens is that the central bank creates money and puts it in the hands of the bank, and then the bank creates more money by giving credit, and that's how demand gets stimulated. So in 2009, although the Fed put a lot of money in the hands of the banks, the credit growth still didn't happen in a very big way. However, this time, what has happened is the Fed has put in about $2 trillion in the banking system immediately the moment the lockdown was announced. But further to that, even the government has used their fiscal balance sheet to put money directly in the hands of companies and consumers. So this is really an experiment we have not seen before. I mean, people keep alluding to this period and going back all the way to 1929, which was the Great Depression. But remember, in 1929, this kind of fiscal and monetary programs were not used. I mean, it happened much, much later. So will this kind of stimulus lead to the economy reviving? Will the markets at all-time high lead to economy recovering? Because we've always been told that markets foretell economic recovery, which means that if markets go up, they go up in anticipation, and often they are right. But there are times when they're wrong as well, because if the markets let's say predict an economic recovery and it doesn't happen, then markets can correct back as well. So it's really the jury's still to be out on this. Same thing in India. I mean, what we are seeing is because of the pandemic, a lot of businesses have been shut last couple of months. Slowly, a lot of businesses are opening up, and it's not just businesses opening up. There are issues of supply chain, because these companies, even if they are operating at reasonable utilization levels, they need to get their product back into the market. More importantly, even if they get their product back into the market, the consumer centers need to be open. And today, the pain is highest in the consumer centers like Bombay or NCR. So again, even in India, there has been a lot of monetary support which has been given. I mean, RBI has created almost close to 11 lakh crores of liquidity of which about 4.5 lakh crores of cash is leaked out, but still 7 lakh crores of liquidity, which can potentially create 22 lakh crores of demand through credit. And gradually, I do believe that the credit will flow. And we can already see that in the corporate bond markets. Now, will this lead to an economic recovery or the markets are wrong and it doesn't lead to an economic recovery? Time will tell. So my point, Nitin, here is that I think instead of trying to predict the next 3 to 6 months to 9 months, I think at least longer term investors need to look out 2 to 3 years, because remember, for longer term investors, any correction like this is an opportunity. And what we believe, and this is what we've been messaging for the last two months, is that people need to get invested in their equity allocations over the next 6 to 9 months gradually. Now, whenever markets fall sharply, at that point in time, you could bring forward some of those installments to get a better average. Similarly, now my advice to investors is that if markets do rally sharply, at that point in time, you may want to forego 1 or 2 installments. Because in the longer run, remember, business valuations are a function of the future cash flows and the moat that the business has built. No business gets valued on 1 year's P&L or income. And the businesses that our funds are investing in, or some of our strategies are investing in, are the top 100, 200 businesses in India. And a lot of this business are going to come out much stronger on the other side, because you're going to see many small, medium-sized businesses not making it through this crisis. And hence, a lot of that business, when things normalize, will move to these top-notch quality businesses. So I'm very clear, Nitin, that I think the next 6 to 9 months are going to be extremely volatile, and the period could extend as well, because nobody knows how this pandemic will play out. Whether this kind of liquidity that global markets are seeing and developed countries are putting out, and they're using insane amount of fiscal room as well. India is not using their fisc as of now. They've done a lot of things on the monetary side. Whether this will lead to an economic recovery or you don't see demand recovering as we expect as of now, time will tell, and markets will obviously react based on that. But net, Nitin, these are very volatile times. It's very difficult for a shorter term investor to trade in these markets. But for longer term investor, I think it's an opportunity to complete equity allocations, or let's say if markets head lower, like in March, I think it's also a tactical opportunity to go overweight. So this is how I think one should look at the equity markets as of now. And we prefer that investors choose multi-cap strategies of our chosen 4C managers, rather than trying to predict whether mid-cap, small caps will do better or large caps will do better. I think there are companies across the space which will do well, and it is not about mid, small or large cap. It is more about the type of company, the sector they are in, and the state of their balance sheet. So it's different for different people and companies.
Right. Absolutely. You did touch upon the stimulus.
Yes.
And one of the big talking points last month in the domestic markets was the rupees 20 lakh crore economic package that the government rolled out.
Yes.
Although it contained a few short-term measures to improve liquidity, it did contain certain long-term reforms for economic improvement. What is your assessment and your key takeaways from this package? And what do you think is the direct impact on the fiscal deficit for FY21?
Right. So there has been a lot of apprehension around the 20 lakh crore package. Now, there are a lot of data points which the government has which we do not have. So I definitely do not want to make a comment on whether this is right or wrong. But I think if you look at the kind of package that the government has rolled out on the fiscal side, it has been very, very conservative. I mean, we've done close to about 2.5 to 3 lakh crores in terms of actual money printing, right? In terms of guarantees, in terms of some of the programs that they have launched for SMEs, MSMEs, as well as for non-banking financial companies, the smaller as well as medium-sized ones, because that is where the pain is the highest. I think the amount is much larger, but they've chosen to do it by way of fiscal guarantees rather than actually putting hard cash in the hands of the SMEs or NBFCs. Now, why they have chosen this route, I think, is because as I said earlier, nobody knows how long this pandemic will last, whether we'll have a second wave, and they would like to reserve fiscal room in case we have another bout of stress on the health side or on the economic side. Because remember, unlike the US, which is the reserve currency of the world, and hence probably they have far greater fiscal room than us. And I'm not saying for once that we don't have fiscal room. We definitely have fiscal room. But remember, we are already looking at 11% fiscal deficit. I'm talking about combined fiscal deficit between the state and the center. And we are already at about 70-75% debt to GDP if I combine the states. Now, the moment you start going above 80%, and on the fiscal deficit side, if you start going above 11%, it can be pretty dangerous for a developing country like ours. So I think it is right that the government has been conservative, but RBI has nowhere been conservative, Nitin. I mean, if you compare RBI to even Fed, I think our RBI has come out all guns blazing. I mean, like I said, they have in toto through their buyback programs, OMOs, and LTROs as well as TLTROs put a cumulative of close to 11 lakh crores, of which, like I said, there has been currency leakage. So there is net 7 to 7.5 lakh crores. Then they have done targeted programs like TLTROs, where they have first chosen to give credit to banks to buy corporate bonds. Then they, in the second package, they chose to give credit to or liquidity to banks to buy papers of NBFCs, large, medium, as well as small NBFCs, where they have carved out certain tranches. Now, this is already working. If you look at some of the yields in the AAA space, we were at 6.5 to 7% about a month and a half back. You're down to 5.5% to 5.75% in the AAA bond space. In let's say a lot of the NBFC names, the AA names, where you did trade at double-digit yields, and people were finding it difficult to get refinancing in the bond markets at least. Now they are down to single-digit numbers, and credit to them has become a lot easier. And I believe that it will keep getting better. It will keep getting easier for a lot of the decent AA, single A names to get financing, right? The other thing I definitely want to point out, Nitin, there was this lot of stress around mutual funds in April, and one of the larger mutual funds shut down 6 of their schemes due to credit issues and liquidity challenges. Today, when I looked at the data, the entire mutual fund debt AUMs, only up close to about 11 to 12% is in AA plus and lower. So really, the mutual fund space has become a lot more conservative, and I think people need not be worried about at least credit issues going forward in the mutual fund space. However, as a house, as you know, Nitin, we are only recommending incremental exposure in very high quality AAA names, and that too in shorter maturity, because even from an interest rate point of view, you're at the lower end of the curve at this point in time.
Very right. And while we are on the fixed income space, at the shorter end of the curve with so much of abundant liquidity, and the reverse repo at 3.35% really becoming the operating rate, what would be your advice for short-term parking avenues? There has been a lot of discussion on that aspect as well. So we would like to hear your thoughts.
Right. So what has happened is, with this amount of liquidity coming into the banking system, the money market rates have collapsed. So as you know, the reverse repo rate, the rate at which RBI refinances banks is, or rather banks park money with RBI, is at 3.35%. And the repo rate, the rate at which RBI refinances banks, is at 3.75%. Now, because the liquidity is so high in the banking system, the rate at which banks borrow from each other has actually dropped below even the reverse repo rate. So liquid funds participate in that market, and hence liquid funds are yielding actually close to 3.75%. And this is a big, if I may say, drag on monies that corporates are parking in liquid funds. Now, I think corporates as well as individuals, need to seriously look at their liquidity position and definitely earmark the money that they feel they are not going to need for at least 3 to 6 months or higher. Now that money can definitely go into arbitrage funds. Now, I know there has been a lot of debate and controversy around arbitrage funds as well, as returns have been volatile in the near term, and there has been a lot of education happening in this category on how arbitrage fund works and how the spreads are evolving there. Now, just to cut the noise, let me tell you that arbitrage funds as a category, people should definitely look at this category for 3 to 6 months, or rather, if I were to be absolutely confident, I think you should look at 6 months plus. Now, a lot of funds that people have in liquid funds remain invested, as you know, even within our clients for 6 months, a year, 2 years. This is really uncertain money. Now, if that is the kind of horizon, I think arbitrage funds are a no-brainer. Why? Because month to month, there are a lot of dynamics which dictate how much returns arbitrage funds provide. Now, it is to do with what kind of arbitrage funds or opportunities are available in the market, which is dependent on how bullish or bearish the markets are. Because the more bullish the markets are, and 70% of the participation comes from FIIs, they're willing to pay a higher carry to carry equity positions, right? So you make a little higher returns. Secondly, arbitrage funds are also closely linked to the money market rates. So broadly, I think in terms of expectation, even if you come to arbitrage funds from a 3 to 6 months or greater than 6 month point of view, you must expect a return which is higher than liquid ultra short-term funds. So I think if you expect anywhere between 4 to 5%, you will not be disappointed. Now, why should someone be in arbitrage funds for such low returns? That brings me to the second part of the advantage for arbitrage funds, which is the taxation. Arbitrage funds, even if you remove your money before 1 year, you pay short-term capital gains as opposed to marginal tax which you pay in liquid and ultra short-term, which is much lower, right? And if you spend more than 1 year in arbitrage funds, the taxation drops further lower, which is 10% plus surcharge, which is equity type taxation, right? The moment you say that I have this money for 3 years plus, then debt funds certainly become attractive. And there I think the AAA category, which is 2 to 4 year banking PSU funds, corporate bond funds, are still attractive. The absolute yields may have collapsed at 5.5% or 5.75%, but if you compare it to where liquid funds are, where repo is, where bank rates are, deposit rates are, it is still very, very attractive. So in a nutshell, I think the corporate bond space, PSU banking bond space still is attractive at 5.5% or 6%, that range. And for anything lower than 3 years, I think, and greater than 3 months, 6 months, arbitrage funds come out as a very, very attractive option. I would advise people to avoid very long-term maturity funds like 10-year roll downs, or roll downs are still fine. I think people should hold on, but incremental money should not be allocated, because you're at the lower end of the yield curve. So that's what I think.
And finally, coming to alternates, gold has continued to gain prominence as a safe haven in today's times. From your past observations of scenarios which have seen very low real rates as well as high fiscal deficits, why do you think gold is an important asset class today, and how would you want investors to participate in gold?
So, as you know, Nitin, we've been messaging clients to take gold exposure from last year. And our view was based on the simple fact that markets were frothy globally. I'm not talking about India. Globally, markets were frothy. And typically when there is a disturbance in equity markets and there are disruptions in global money markets, gold tends to act as a safe haven, and a lot of money goes into gold as an asset class, right? So, and plus over the last 6 months, even before this COVID crisis, if you recollect, Fed had started cutting rates, policy rates, right? And they had started saying that if US growth tapers down, then we are not averse to putting more liquidity as well in the system. But typically these times are normally pretty good for gold. So gold has done phenomenally well. Now gold has delivered close to 30% over the last one year. Now normally when an asset class does so well, in the near term, the returns are a little challenging. So I think definitely people should moderate their expectations from gold. But gold is still a great asset class to hold in one's portfolio. It could be anywhere between 5 to 15%, depending on your attitude to risk and the kind of portfolio you have. And that is something that you should discuss with your advisor and have an investment charter in place. But why is gold still great as an asset class? I think the fundamentals are very attractive for gold, Nitin. When does gold do well? Gold does well when your money doesn't earn sufficient returns in the form of interest, or at times earn negative returns. Now, when I say negative returns, I'm not talking about your money earning negative returns on your capital, which is actually happening in certain developed markets, but I'm talking about negative real returns. So when the Fed is putting so much of money in the economy, and you don't see a demand recovery in the near term, what tends to happen is that inflation tends to rear its head. So, for example, if interest rates, 10-year bond yields of US remain below 1%, and sometime, inflation starts rearing its head again and goes to, let's say, 1.5%, you actually have a situation that by keeping money in banks or by keeping money in fixed deposits, you actually have a negative real return and the value of money erodes. Now, this is a classic situation in which gold does extremely well. And there are many, many such examples of the past, the 70s, the 2003 to 7, where gold has done extremely well. So that's why fundamentally the situation is ripe for gold, and hence gold exposure should be carried. Now, there could be a situation where gold doesn't do well. In that situation also, you should be happy because a lot of your other asset classes do well. So it's about diversification and not about binary outcomes, Nitin. And again, I'm saying these are times, if you've not done your investment charter, I think clients must reach out to our advisors and get their investment charter done.
So I think that's it for this discussion. I think we've covered all the points. So thank you very much, Ashish, for those insights. I'm sure all our viewers found that very, very helpful. And to everyone watching, thank you so much for watching, and we'll see you in the next edition.
Yeah, it's great to do it live this time, Nitin, and I hope our clients and the viewers have benefited from our discussion. And for further details, people can go through the Alpha Strategist, this month's Alpha Strategist, which is out there in the public domain. The theme is the Great Divide. Everybody's trying to figure out why the markets are at one state and economies another. I'm sure people will get a lot of insights from this edition of Alpha Strategist. Subscribe to our YouTube channel if you want to watch any further interactions like this. Thank you very much. Thank you, Nitin, for doing this.
Thanks, Ashish. Thank you, everyone.